what are the usual trigger points for tax authorities to start auditing, investigating challenging businesses on their transfer pricing? Do tax authorities often go on fishing expeditions targeting large multinational enterprises trying to nitpick their tax and transfer pricing practices? Or are there usually some blunders that trigger authorities to dig deeper? Now, the answer I prepared is that tax authorities initiate audits or investigations into TP practices based on various triggers and indicators rather than engaging on arbitrary fishing expeditions. Their goal is to ensure compliance with local and international tax laws, aiming to prevent tax base erosion and profit sharing. Now, common triggers would be, for instance, if the Revenue Authority has identified some form of tax planning where tax rates within a group of companies has been reduced by shifting profits from the parent company to subsidiary companies. That often would be the trigger for a transfer pricing and bigger international tax audit. In the absence of there being any differential in the tax rates between the parent company and the subsidiary, that becomes a very good defense should one be attacked on the transfer pricing practices of the company. And we successfully used that in a very recent transfer pricing case that was argued by my team in the tax court in one of the jurisdictions that we cover. Now, others are inconsistencies in transfer pricing documentation. Tax authorities expect detailed, accurate, and comprehensive TP documentation that aligns with the arm's length principle and local regulations. Inconsistencies, lack of documentation, or failure to meet documentation requirements will no doubt trigger an audit. So you need to make sure that your transfer pricing documentation is up to date and the reporting that your particular tax authority requires, country by country, etc., that those in-country regulations have been fully complied with. Now, significant intercompany transactions. Here again, reference to my first example of fairly aggressive tax planning structures that have been put into play, where it is clear that the parent company tax rate is higher than that which is being paid by subsidiary companies where profits have been shifted to. Then disparities in financial performance. Entities with a multinational enterprise structure showing continuous losses, especially in high tax jurisdictions, while associated enterprises in low tax jurisdiction report high profits, will no doubt attract attention. Outcomes of country by country reporting. Under the OECD's base erosion and profit shifting initiatives, multinationals are required to file country by country reports that provide a breakdown of their income, taxes, and economic activity by jurisdiction. Tax authorities will use these reports to identify risks by specifically looking at what liabilities are given to the different subsidiaries versus the rewards, and there the DEMPI provisions would be of importance. And so make sure that those country by country reporting requirements are fully met and carefully considered when the reports are made. Transactions with tax havens. Once again, this comes back to the tax planning initiatives. Any type of tax planning where there is a move of the tax rate from the parent jurisdiction to the subsidiary jurisdictions is no doubt going to trigger a transfer pricing audit. So you've got to make absolutely certain that if there is a lower tax rate in respect of a subsidiary, that subsidiary truly is contributing what is required to justify the profits that it is earning. Changes in transfer pricing policies or business restructurings. Significant changes in a multinational's transfer pricing policies or business restructurings can impact the allocation of profits among jurisdictions, and this once again can trigger a review by the revenue authorities. Requests for advanced pricing arrangements or MAPs. While APAs and MAPs are tools for preventing disputes, the information disclosed during the application process is usually quite extensive and can reveal areas of potential concern that would trigger further scrutiny and audits. Once again, the preparation of that type of documentation is absolutely important to consider the concentric ring effect of how that might affect the group as a whole. Industry-specific factors. Tax authorities may target industries with high-value intangible assets, complex supply chains, or those known for aggressive and tax planning strategies, where they would typically audit these particular industries more often. Now, any type of intellectual property is complex, and there are a variety of ways of valuing the transactions and what type of transactions are to be valued and how that is to be disclosed. Now, in my book, Conducting a TP Trial, I have used intellectual property tax disputes as an example. So please take a look at the book, and you will find some of the insights there extremely useful. Then, of course, there's public information and whistleblower scenarios. Publicity about a particular company might, in the media, might trigger an exposure and an exposure to an audit. So once again, you'll find often public companies are extremely sensitive to any information that is being published about them. And sometimes they can be the subject of some kind of sort of investigative journal process where it has happened in the past, for instance, in the beer industry, where attacks were made on various beer manufacturing or beer makers in that they were supplying significant amount of beers in country but were showing virtually no profits, and that in itself triggered extensive audits in those particular groups. Now, tax authorities target areas where there is a higher risk of non-compliance or potential for significant tax base erosion, which is exposed by these types of reports. While large multinationals may seem to be under increased scrutiny due to their size and the complexity of their operations, the focus is typically on specific risk indicators rather than just arbitrary examinations. But be that as it may, once the audit commences, it can in itself become somewhat of a fishing expedition. So once again, in my book, Tax Intelligence, which was made available to you, as well as my new textbook, Conducting a TP Trial, I say it's extremely important that at the commencement of an audit, the parameters of that audit are agreed with the Revenue Authority so that the audit itself doesn't become a potentially broad-based fishing expedition. Now, you can't stop the Revenue Authority from wanting to expand their audit, but you can certainly limit the scope of the audit at commencement. And of course, if there's reason for them to expand the audit, you would simply ask them to please justify why they're doing so. But importantly, if they conduct the audit outside the parameters of what has been agreed between the taxpayer multinational and the Revenue Authority, this gives rise to opportunities for you, the multinational, and whichever company or companies are being affected, to ratchet down and stop what would become a fishing expedition audit. And I've had experience in numerous cases where we've actually closed out the audit without any negative effect to that corporation. But once again, please take a look at the additional information in the books that I've mentioned. Tax Intelligence, which can be obtained in PDF form. It's an older textbook on tax risk management techniques. And my latest draft, Conducting a TP Trial.